Small business owners, listen up. The IRS won't wait until tax season to come knocking. And if you're not making estimated tax payments, you could be in for a nasty surprise. But don't worry. Today, I'll break down exactly what you need to know to avoid penalties and keep more of your hard-earned cash. Let's dig into it. So today we're talking about estimated taxes and why are they so important? First, estimated taxes are payments that you make against income that is not subject to withholding. So think of things like self-employed income, rental income, investment gains or earnings that you have. This is all income that you're receiving that doesn't have taxes being withheld against it. And that's why estimated taxes are so important, because that is, if you have no taxes taken out on income that you're receiving, it's your responsibility to make estimated tax payments against those. So let's think of this as a W-2, because I think that will help drive home this concept a little further. As a W-2 worker, you have an employer and they're paying you your regular wages. And as they're paying you those wages, they're taking taxes out of those payments to you. So you receive a paycheck, and that paycheck, that money that you receive in your account, is what we call take-home pay. And that take-home pay means that before you earn more money than that, but the IRS has already taken out money out for Social Security, money out for Medicare, money out for federal withholding, for state withholding. Your employer is doing all of this for you. But as a self-employed individual, or someone that owns rental property, or someone that has a large investment earnings or gains, you don't have somebody withholding those taxes for you, and it's your responsibility to do that. And the United States is a pay-as-you-earn system. And this is an important concept to understand, because a lot of people think, well, I just filed my taxes in April and I have to file my tax return by April 15th. And so that's when I have to pay my taxes by. But the IRS, or the government, says no. Like, the US is a pay-as-you-earn system, which means that you owe taxes on funds as you earn it. And this makes sense for W-2 workers, right? Because your employer is taking it out as you're earning it. Every paycheck, they're taking it out and they're sending it to the government on your behalf. But as a self-employed individual, now it's your responsibility to do that. And so that's what we want to talk about. That's what we want to drive home and talk about the importance of doing it, because if you don't do it, you could have interest and penalties, interest and penalties that you don't want to have to pay. But if you don't pay enough, those could come up. And so typically, who do we say needs to pay estimated taxes? Anyone that's expecting to owe more than $1,000 in taxes at year end. So if your employer, if you're just a W-2 worker, likely no estimated taxes need to be done by yours, especially if you don't have any self-employed income outside of that, rental income, investment income, or anything like that. Your employer is taking care of that for you, and more often than not, you don't need to pay estimated taxes unless your employer is taking out the incorrect amount. But where this is super important is when we're talking to small business owners, because you are the employer. You don't have someone doing that for you. And so that's why it's so important to think about this estimated taxes and start paying it, because the US requires it. The US, again, is a pay-as-you-earn system. You owe taxes as you earn funds, which, again, let's look at a W-2 employee. That's being done automatically by your employer. But now, since you don't have an employer to do this for you, you're responsible for this. So let's talk about how this compares to the year-end tax return, because that's a lot of the confusion I always get. Is they say, Mike, I filed my taxes April 15th. That's when they're due. And I want to talk about this concept of a year-end tax return, or that tax preparation and filing. And all that is really just a reconciliation. When you file your tax return, you're telling the government, here's all the income, here's all the earnings, here's my deductions, here's everything else that happened throughout the year, and you're taking that, sending it to them, and they're sending it off to the government and state agencies. That's just a reconciliation. You're reporting to them what you did throughout the year. But that doesn't mean that that's when the tax is due. That's just the reconciliation. That's just the report that they're requiring of you. So when you file that tax return, you're either going to have a refund or an amount due. And if you have a refund, that just means that over the course of the year, you paid too much in taxes. Maybe you paid too much estimated taxes. Maybe your employer withheld too much on your W-2. And that's okay, because you're going to get that back in a refund when you file that tax return. Again, it's a reconciliation saying, here's what I've earned, here's my tax, here's what I've paid. Now I either owe you or you owe me. And that's where that tax refund or amount due is. Now, if you have an amount due when you file your tax return, that means that you didn't make enough in estimated tax payments. That means there wasn't enough withholdings being completed, and now you owe when you file your tax return. So that is where the year-end tax return comes into play in all this. Is it's just a year-end reconciliation saying, here's what's going on, Now let's figure out if I owe you or you owe me. That's all a tax return is. It has nothing to do with when that actual amount is due. So just make that very clear. Now, real quick, if you are looking for tax strategies you can actually implement, I built a software called Taxon. We don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with clear, step-by-step guidance and full implementation. If you're serious about paying the least amount of taxes legally possible this year, click the link in the description below and book a free discovery call with our team. All right, now back to estimated taxes. So now that we kind of know this concept of what estimated taxes are, why they come into play, and kind of what this year-end tax return, when you get a refund or an amount due, what that means into it, let's talk about when estimated taxes are due, because they're due on a quarterly basis. So you have till that quarterly due date to make those payments. But the quarter for estimated tax payments isn't what you think of as a typical quarter. So typically a quarter is 3 months. January, February, March is 1 quarter, April, May, June is 2 quarters, and so on. But when we talk about estimated taxes, the IRS doesn't look at the quarters in that way. And so this can also oftentimes cause a lot of confusion, saying, wait, I thought I had until this date to file it. No, because in true IRS fashion, they need to make things a little bit more complicated, a little bit harder to understand. So let's talk about those specific due dates. Quarter 1 estimated tax payments are due April 15th. This is for earnings that you had for January through March. So anything that you earned from January through March, the tax on that is due on April 15th. Now that's April 15th this year, not next year when you file your tax return, April 15th in the current year. So quarter 1 estimated tax payments due April 15th, that's for January through March earnings. Quarter 2, and this is where it gets a little funky, quarter 2 estimated tax payments are due June 15th, and that is just for April earnings and May earnings. So quarter 2 estimated tax payments due June 15th, that's for April earnings and May earnings. Quarter 3 estimated tax payments are due September 15th. That's for June, July, and August earnings. And then quarter 4 payments are due January 15th. And that's January 15th next year. That's for September, October, November, and December earnings. Again, these are not your typical quarters, but this is what the IRS says when it comes to estimated tax payments. And then one thing to think about too is that if the 15th of the month, so I talked about April 15th, June 15th, September 15th, and January 15th. If the 15th of the month falls on a weekend or a holiday, you're just going to go to the next business day. That's going to be the actual due date. So it's not going to be due on a weekend or a holiday. So just something to consider there again. So set reminders to yourself. Put something in your calendar to do that calculation. We're going to talk about how do you calculate this, but set reminders to make sure that you're not missing these, because remember, the US is a pay as you earn system. So any money that you earn from January through March, January, February, or March, the tax on those earnings is due April 15th. That's Q1. Any money that you earned in April and May, that's quarter 2, the tax on those earnings is due June 15th. Any money that you earned from June, July, and August, that's quarter 3, the taxes on those are due September 15th. And then any money that you earned in September, October, November, and December, the tax on those earnings are due January 15th. Now also don't forget about the state, because if you're in a state that has a state tax liability, we also need to be considering that as well. So the next question that comes up is that, okay, I understand what estimated taxes are. I understand why they exist. I understand the due dates. Now, how do I calculate them? And fortunately, the IRS has a couple what they call safe harbors. And so a safe harbor means that if you do this, you're not going to have any penalties or interest if you underpaid. And so there's 2 safe harbors. The first one is that you pay 100% of your last year's tax liability. So let's say last year's tax bill liability was $20,000. If you pay $20,000 this year, you will not be faced with penalties or interest. Now, when you go file your return, you might get a refund or you might have more due, but there will not be penalties or interest because you met that safe harbor. Now, if your income is over $150,000, that 100% turns into 110%. So that's the first safe harbor. 100% of previous tax year's liability, or 110 if your income's over $150,000. If you pay that at a minimum, you're not gonna have to face any penalties or interest. The other safe harbor is that you pay 90% of your actual tax liability for the current year, break out into the quarterly estimates. So that's the other safe harbor. Let's say that you estimate your tax liability to be $100,000. You pay an estimated taxes of $90,000. you're not going to face penalties or interest when you go file your tax return. You're still going to have that amount due, but you're not going to face interest and penalties. So I think that this is an important thing to understand. Let's go back to these safe harbors because these are the things that we can avoid that. Now, I like to give this example when I talk about a safe harbor. Let's say that last year you had a tax liability of $80,000. So $80,000 in estimated tax payments. If we take that 80 divided by 4, that's 20,000. If we wanted to pay 100%, and now it'd be 110, but let's, for easy math, say it's 100% of previous tax liability, we'd have to make an estimated tax payment of $20,000 every quarter. That would be part of that safe harbor. Now let's say last year we made a couple $100,000, but this year we hit the lottery and we made $2 million. We still can pay 100% or 110% of last year's tax liability and stay in that safe harbor. Now, when we go to file our tax return, there's going to be a large amount due there because we didn't pay nearly enough in estimated taxes, but we're not going to face penalties or interest on that large amount due because we hit that IRS safe harbor. So that's why safe harbors are so important. Again, the safe harbor first option is 100% of your tax liability last year, and that moves to 110% if your income was over $150,000. Or the second option for safe harbor is 90% of the current year's tax liability. So how do you estimate your taxes? First, estimate your income. Kind of find out where your income is going to be, then calculate what your tax liability is going to be, factor in any kind of expenses, deductions, credits, all those different things, divide by 4 for a quarterly payment, and then just make your payments on time. That's how you do estimated tax payments. So let's talk about this. We're talking about interest and penalties and kind of the importance of filing estimated tax payments. But what happens if you don't pay estimated tax payments? There's two main things. There's penalties and interest. And that's why it's so important to try to avoid having to pay these. And it's so important to be on top of our estimated tax payments. So let's talk about penalties first. The penalty is 0.5% of any unpaid balance per month up to a maximum of 25%. So it's 0.5% of that unpaid tax balance per month. That's the penalty. And then there's interest. And the interest is based on federal short-term interest rates plus 3 percentage points. So this usually falls in the 3 to 8% mark. But last year, as an example, when interest rates are high, that interest is really, really high. And so that's an important thing to think about. Oftentimes, that interest might be on the lower end, and it's not that big of a deal. Maybe you say, hey, I'm going to forego estimated tax payments because I can earn more than that in the market, and then I'm just going to pay when the time comes. Now, if you do that method, you probably want to be putting that money in the market, putting it to work so that can actually be realistic. But in high income years, that might be harder to reach. So make sure you're thinking about that. If you do not pay estimated taxes and you do not hit any kind of safe harbor, you're going to have a penalty of 0.5% of the unpaid balance per month. And then you're going to have interest. And that interest is usually around 3 to 8%. When the interest rate's high, it's going to be closer to that 8%. And also, don't forget about the state. A lot of what we're talking about today is the IRS, the federal government. But don't forget about your state. If you live in a state with an income tax, you have to factor that in as well. So let's talk about how do you pay them. This is the easy part. You can go online to the IRS website. You can use a bank account, credit card. Just go to the IRS website, find the information, click make a payment, make an estimated tax payment, go to your state website. It's very easy and safe to do online. Just make sure you're on an actual website for the government. Don't try to click some type of ad or something. Make sure you're on an actual government website. So that's option 1. Just pay online using a bank account or credit card. Now, no, if you're paying with a credit card, there likely is going to be some type of fee. The IRS works with different vendors that can kind of process credit cards for payments, but they do charge a fee for that. So just take that into consideration. But you can also make these payments by mail. Just write a check and include with it a copy of Form 1040-ES and mail that payment to the IRS. Now, this part, I typically say don't do this because sometimes it can take a while for the IRS to process that. Even though you're trying to pay them, sometimes it can take a while. So oftentimes I say just do it electronically because it makes it a lot easier. Now, again, if your state has some state income tax, make sure you check their website, find out how do you make those estimated tax payments. But the important thing is understanding what estimated tax payments are and then saying, do I need to make them? And if you do, mark it on your calendar and start making those payments. So let's just kind of recap that again. What are estimated taxes? Why are they important? Basically, estimated taxes are just making payments against your earnings that you eventually will reconcile against when you file your tax return. This is mainly for self-employed individuals, those with rental income, investment gains or earnings, basically those that are earning income that there is no withholding being taken out of it. If you're just a W-2 worker, your employer is doing that withholding for you, and usually it's pretty accurate. You have plus or minus when you come to file your tax return. But it's important because the US is a pay-as-you-earn system. You owe taxes as you earn it. It's not just, hey, wait till tax season, wait till April next year, and that's when I file it. No, you need to pay as you earn it. If you don't, there could be interest and penalties. Then the end of your tax return is simply just a reconciliation saying, here's what I've earned, here's what I owe, or here's what you're gonna give a refund, and you're sending it off. But there's interest or penalties if we did not pay enough. Now, when our estimated tax is due, quarter 1 is due April 15th. That's for January through March earnings. Quarter 2 is due June 15th. That's for April and May earnings. Quarter 3 is due September 15th. That's for June, July, and August earnings. And quarter 4 is due January 15th. That's for September, October, November, and December earnings. Now, the IRS does offer some safe harbors. And basically, if you qualify under these safe harbors, you're not going to have penalties or interest if you underpay. Now, you're still gonna have to owe that underpaid amount, but you're not gonna face penalties or interest if you hit these safe harbors. And the first safe harbor is 100% of last year's tax liability. Now, if you earn over $150,000, that 100% turns to 110% of last year's tax liability. And then the other safe harbor is 90% of the current year's tax liability. If you pay at least 90%, you'll just owe the last 10% when you file your tax return, no penalties or interest. If you don't pay them, you're going to face with penalties. 0.5% of an unpaid balance per month plus interest, usually around 3 to 8%. How do you pay these? Just simply go to the IRS website. You can pay using a bank account, credit card, and also don't forget about your state website as well. All right, so now that you know what estimated taxes are, how they work, and how to pay them, the key takeaway, stay ahead of the game and make those payments on time. If you found this helpful, hit that like button and subscribe for more small business tax saving tips. If you want to start actually lowering your tax bill and need assistance to go from tax planning to full implementation, check out Taxum. We are offering a free discovery call. Just click the link in the notes below to book it now. Thanks for tuning in, and I'll see you on the next one.